Good afternoon, everyone. I'm Jerry Jones, joined by John O'Hare. This is the O'Hare Wealth Management Weekly Update for December 19th, 2024. We're glad you could join us. We want to make sure that everyone is aware of some upcoming dates that should be on your calendar, especially with the holidays near at hand. Tuesday, December 24th, the markets and O'Hare Wealth will be closed at 12 noon Central Time. On Wednesday, the 25th, markets in O'Hare will be closed all day. No weekly update that week on December 26th. So we won't see you that week. Same for the following week on Wednesday, January 1st. The markets and O'Hare Wealth Management will be closed, and we won't have a weekly update on January the 2nd. However, I will note December 31st, the office will be open in case you have any year-end needs that hopefully we can address prior to that time. But if you have something that comes to the 11th hour on the 31st, we'll be here to take care of that. So we wanted to make sure you were aware of those upcoming holiday hours. Also, just a reminder about things you should have received in your mail: Everplans and EverSafe. Everplans organize and securely store all of your information, along with giving the gift of clarity, whereas EverSafe monitor and analyzes your credit and protects your identity online. More to come about that as the new year progresses, but we hope you've seen the value of that. How do these platforms protect my data? In the case of EverSafe, this is an SOC2 certified plan, also HIPAA compliant, and all data is encrypted with a combination of public and private encryption with uniquely generated keys for each user. With regards to EverPlans, also SOC2 certified. Both of those, that's the gold standard of the industry. So we want to make sure you understand we're taking the highest and best uses here and applying those to both of these plans with 256-bit encryption to store and transmit data, and security practices are monitored and verified by Norton. Raymond James has approved both of these plans for use by you, our clients, and this is after an extensive and exhaustive search period. So please be rest assured that these plans were looked at thoroughly before they were made available to you. We're getting some exciting feedback initially, and if you have questions on those plans, don't hesitate to reach out to us at service@o'harewealth.com or text or call us at 414-644-0060. I love having Megan run the slides, John. This is great. I don't have to push
It is
anything.
easier.
She kind of cues the talent. So, John, the main question we have today is the market was waiting for the Fed to cut rates yesterday, and they did. So why did the market react so poorly?
Yes, I think I think the market personally, I just think the market overreacted. We've been saying for a while here that the market's extended and that we would expect some type of correction coming. And after 2 years of very good market performance, quite frankly, a lot of people were looking for an excuse to sell some stocks. The reason the market's so mad is the Federal Reserve said two things that most people found conflicting yesterday. They said inflation is going to be higher next year than they originally expected. And they also said they're going to lower rates yesterday. So the market looked at that as confused. Well, if you think inflation is going to be higher, why are you lowering rates? And the real answer was, we're going to lower them, but we're going to slow down the rate cuts next year. Most of the market was looking for 3 or 4 more cuts next year, and each cut is a quarter point or 25 basis points. Now the market is looking for 2 at the most, and there is some sign or thought that they might pause here for a long time. The markets sold off a lot, but when you think about the reasoning behind this, it's because the economy is so strong. Inflation is at 2.8% year over year, and the goal was to get it down to 2.1% by the end of 2025. Now, the Fed says it's going to be more like 2.5% for 2025. So that's still trending down, but not as fast as they originally expected. I think the market personally overreacted to this. we really have kind of a Goldilocks right now. We have a strong economy. In fact, the GDP number for the third quarter just got revised to 3.1%, up from 2.8%. We still have record low unemployment, but rates do hurt a bit. They hurt small businesses for borrowing. They certainly hurt home buyers for mortgages. So those areas will struggle a little bit. But overall, the message was this economy is too strong to get inflation lower quicker. And that's typically good for profits, which should be good for stocks. So having stock indexes fall 3% or 2.5% yesterday seemed like an overreaction. But we were high anyways. We had to come down. I have a couple of slides here. We'll start with the first one. There's 4 lines on here. I want you to look at the bottom line first. And this is what we call the yield curve. And a normal yield curve, which is the one at the bottom, and this is for government treasuries. A normal yield curve is where you pay less interest for short borrowing, 3 months, 2 years, 3 years, and you pay higher interest for long borrowing, 10, 20, 30 years. And you notice at the bottom, if you go back 4.5 years ago, we had a normal yield curve. That typically means the market is growing. I should say the economy is growing. When the Fed got worried about inflation, they raised the short rates significantly. Look back at 2020, short rates were 0.25%. If you look at the green line, you see the Fed took short rates all the way up to 5.5%. And you notice now at 5.5%, it was costing you more to borrow for 3 months, 1 year, 2 years than it was to borrow 10, 20, and 30 years. That's called an inverted yield curve. It typically means you're going to have a slowing economy. And the Fed does this to slow economic activity to get rid of inflation. And remember, back 2 years ago, inflation did peak at 9%, and now it's 2.8. So it has worked to bring inflation back in line. Now, if we look at the current yield curve, which is the dark blue one that starts at 4.4, it says December 18th, 2024. The yield curve is back to slightly upward trending, which is getting back to more of a yield curve we saw in 2020. The overall rates are still higher, but a rising yield curve typically means you have a growing economy. So it's a strong sign for the economy to continue to grow and profits to continue to be good. That said, and we've been saying this for a while, the era of extremely low interest rates, where we all got our 3% mortgages or 2.5%, are gone. And this next chart that we brought up is Fed's expectations for rates. And you see from the middle of the chart, the bottom in 2008, when the Fed took rates to basically zero. And then there was a brief period in 17, 18 where they raised again and then took them back to zero during COVID. Money was basically free. And I know myself, I know lots of people who got mortgages that were in the 2s. I have a 2.5% mortgage on my place in Cedarburg. Lots of people have 3% mortgages. We're never going back, I believe, we're never going back to those lower rates in our lifetime. The rates we're seeing now are going to be back to more than normal before the financial crash. If you look way over there, the beginning of that chart in 93, short rates were 3%. And in the 80s and 90s, you were used to short rates being 3%, 4%, 5%. Even 2002, when they got to 1%, that was a big surprise. If you look at the far right-hand side, we call that the dot plot. That shows you, the purple shows you where the Fed wants to be over the next 2 years. They're at roughly 4.25, 4.5 right now. They want to get down to 3%, which means short rates will go down over the next 2 years. We'll get back to 3%. So you'll get 3% on CDs and money markets. But long rates are going to stay higher, and probably, my opinion, the 10-year Treasury is probably going to stay at, it's 4.5 today. It's probably going to go to 5% or even a little higher. But that's the environment most of us grew up in, and mortgages are going to be 6%, and and my first mortgage was 13.5, and then in the late 80s, I got a 9% mortgage, and I thought it was a deal. But we're returning to normal, and clearly the economy was not severely slowed down by the rate increases. We still have a pretty robust economy. The other thing I want to mention here is the market gets bent out of shape because the outlook for the Fed changes. I was listening to one of the former Fed board members. His name is Dick Fisher. He's on CNBC a lot. I've watched him for years. He's a very, very smart guy. And he reminded us that 10 years ago, he gave a speech telling people that looking at the dot plot or looking out over the next year or two at where rates are going is somewhat meaningless. He said, we're just dealing with the best information we have at the time. A projection of where rates will be 3, 4, 5 quarters from now is just sort of ridiculous. It's not worth the bother. And I have heard traders on the floor talking about they only look out 30 to 90 days for where things are going. So you have to remember it's a work in progress. And they mention a lot, like Chairman Powell, that he's data dependent. This is data dependent. They have to get the new data. And inflation didn't come down in September and October. And then it slightly came down in November and got better. But this, again, we've said this isn't going to be a clear, smooth, stair-step type system. It stalled here a little bit, and it might stall longer, and then the Fed won't cut. But if things really start to slip, the Fed will cut, and they've got a lot of room to cut and boost the economy. So we are going to be talking about this on our market outlook in January, but we are concerned that after 2 very, very good years of performance, it's hard to see how the market can surge a lot higher next year. And by the way, we saw a survey a few days ago from individual investors, and it's one of the all-time highs. Most individual investors think the market's going to be a lot higher next year. And typically, when everybody's that optimistic, that's not what happens. So we're telling people to be cautious into next year. We're not saying get out of the market, but if we had a flat market next year or down 3%, that would not be a surprise. That would not be abnormal. It could be even down a little more, but if it's -5 or +5, I think that's the reasonable expectation. Now, good news, our bonds are paying us more, so we're making some money there. What I don't see next year, and I'm reminding everybody, when we did our market outlook in January of 22, we said a very similar thing. We said we've had several good years. We said 22 is going to be a flat market at best, and it'll be a transition year. Now, what we didn't know then, that we were going to have the Russians invade Ukraine and spike supplies, and we didn't know the Fed, who said they were going to raise rates maybe 2 or 3 times. They raised them they took it from almost 0 to 5%. They've never raised them faster. You can actually see that on the chart. So in 2022, we ended up with a bear market, and the stock markets went down 20 to 30%, depending on the index. We don't see that happening because we're not going to have another war breakout in 2025, or at least I hope we don't. But also, the Fed is lowering rates now. They're not raising rates, and they're unlikely to agree. At worst case, I think they'll sit on rates most of next year. It's very unlikely they're going to start raising them again. We'd have to have a significant change in the inflation trend. And like I said, it's 2.8. They think it'll be 2.5 next year. They would have liked 2.1, but it's still trending the right way. So yeah, expect kind of a flattish year, but we can be surprised. That's why we don't try and time the market. We could be
I was
surprised.
about to say.
Yeah, there could be better economic news. Who knows? Different stimulus, more tax cuts. You can end up with another strong market. But for now, we'll be cautious. Like I said, I think yesterday was an overreaction, but there were itchy fingers out there wanting to sell things. I hope that
Good to hear.
helps. Let's move on. We're running out
Yeah,
of time.
very thorough discussion of that one. Appreciate that, John. Year-end reminders, folks. One date has passed us. Qualified charitable distributions from IRAs, that is knocking on the door for this Saturday, as well as gifting transfer of eligible securities via DTS. Those are coming up fairly quickly. Roth conversions, that is on Monday. So if you have not done a Roth conversion and you still want to try and get one in, your deadline is Monday. IRA distribution requests, 529s, and et cetera, those are at that end of the year date of December 31st. So once again, if you have anything you see on the list that is pertinent to you, that you know hasn't been completed yet, reach out to us at service@O'Hare Wealth, or for expediency, it's okay to call as well at 414-644-0060. That takes us to our next and final book recommendation of 2024. This has been a good one. Annie Duke, person I got to meet in person at the World Series of Poker one year, thinking in bets, making smarter decisions when you don't have all the facts, which we do a lot in our daily lives. But John, any closing thoughts on that book from your perspective?
It was an easy read. I thought it helps you think about, there is no black and white decisions. There's a probability of a lot of decisions, and you have to recognize that. And like in poker, you got to make the bets that work out probability wise most, but it doesn't mean they work. You still have probability of it not working, and people get the wrong impression. Hey, it didn't work. We did something wrong. No, sometimes you did everything you could, but there's conditions out there. And again, nothing is 100% certain. And it's a good reminder from that book.
And previewing January and February, what an appropriate word, proximity. This book is in very close proximity to being our book recommendation, which is
Yes.
by Robert Walcott and Kaheen Krippendorf. That'll be coming. You'll hear more about that in January and February, but if you want to get ahead of the curve and order it now, please feel free to do so. With that, Megan, I think we have exhausted our time. Thank you
Yep.
all for joining us today. Please, we always encourage providing feedback and also share this recording with people that you care about. And if they have any questions, please forward those on to us. But on behalf of myself and the rest of the O'Hare Wealth Management team, John, I'll let you say it on your own, but we wish everyone a very happy and safe and Merry Christmas and holiday season.
Yes. Hope everybody has a great holiday season. And
Yes.
we'll talk to you in the new year.
Thank you, John. Thank you, everyone. Have a great day.